Hi there, and welcome to the latest edition of the JMI Wealth monthly video series. It's our last video for 2020 as we head into Christmas and the New Year holidays, and we're having a lot of conversations with clients at the moment, and even just personally I'm sure you're also reflecting on the year that's been, and certainly when we're having those conversations with clients, plenty of people would like to see the back of 2020 and are very much looking forward to 2021. And I must say at stages this year I've definitely agreed with them, but it's also important, I think, to reflect on the year and to think about what have we learned from the year. So look, here's some very much top of the head simple comments. The first one is that even in the midst of a recession, in the midst of this pandemic, we've seen asset prices go up. We've seen the share markets now in the last month hit all-time highs in various places around the world. We're seeing a big surge in New Zealand house prices as well, and we're starting to see that around the rest of the world as well. So, I mean, a lot of it does obviously depend on the starting point, and we did see asset prices come off quite a lot, but it does show that even in the midst of a recession, good things can still happen with assets. And the other thing is the New Zealand economy has proven to be remarkably resilient, and I'll talk about that a little bit later on. And the other issue I think that has been very ably illustrated over 2020 is that situations like this throw up a lot of challenges for a lot of companies. I suppose look at a company like THL in New Zealand, which has had to totally rethink its business. That's Tourism Holdings Limited. But there's also opportunities. We're seeing companies involved in online and video type conferencing have gone very well. And think about a company in New Zealand like Fisher & Paykel Healthcare. Has thrown up a lot of opportunities for them, and they've responded very well to those opportunities. So what does this all mean for your investment portfolio and our thinking in terms of setting those portfolios up for the next 12 months? Well, we know interest rates are very low. That means return from assets that are related to interest rates are probably also going to be very low as well. We're talking, and we refer to these as fixed income assets. Now, they do have a place in your portfolio. They tend to dampen the volatility of portfolio. They tend to be the capital stable parts of the portfolio, and they very importantly provide income. But bearing in mind that we think those returns are going to be low, we have been looking around to see whether there are any other income type assets that we can use in the portfolios to fulfill those purposes. One of the things we've looked at and we have increased the exposure to within the portfolios is property. And so you'll find that some of our model portfolios at the moment are running quite high levels of property compared to where we would normally be. Overall though, we have reduced the exposure to income assets within the portfolios, still within the limits that we place for your portfolio, but we have reduced it. And what that means is we've got a little bit more exposure to what we call growth assets. So that's exposure to share markets, to the shares in New Zealand or Australia or around the world. And what we have seen lately is some very strong returns from some of those share markets. Australia in particular, after many years of underperformance, has delivered a very strong performance in November. It was almost 10%, 9.96 to be exact. The US market, the S&P 500, was up over 10% in November, and the New Zealand market didn't quite reach those highs, but it was up almost 6% through the month of November. So the share market returns have been very strong. And we believe with that accommodative monetary policy from the central banks, with the vaccine news that we're getting now, with economies hopefully returning to normal, that the environment is still pretty constructive for share markets leading into 2021. All in all though, we still believe that a well-diversified, well-constructed portfolio of financial assets that's appropriate to your investment objectives and your risk tolerance is still a pretty sensible way for you to meet your financial goals. And on that note, I want you all to relax into the summer holiday, have a great Christmas, have a great New Year, and we'll see you again in 2021.